Rapidly growing international cities worth investing in. Investors around the world are now looking for diverse ways to expand their portfolio. As the global market becomes volatile, investing in real estate must be done carefully. If you are an investor, here are 5 rapidly growing international cities worth investing in. 1. Sydney, Australia. Sydney is not the capital of Australia, but it's the largest city in the country. And it has wonderful weather year-round. Australia as a whole ranks 6th in the world with regards to the Legatum Prosperity Index, which is based upon a variety of factors. Sydney is a thriving city with financial and economic growth, and it contends with some of the world's most expensive real estate prices. For the past 30 years, housing prices have been rising 7.25% a year, making housing a prime investment. Australia had $243 billion in exports in 2014, many of which went out of Sydney. If you are not familiar with this market, there are plenty of companies that will provide free investment property advice. Panama City is the capital of Panama and is known for its legendary megastructure, the Panama Canal. Panama is also well known for its friendly banking regulations, which bring in business clients from around the world. The city itself has close to 900,000 residents and has a tropical climate. The local economy thrives on the business brought in from banking customers and on the fact that the city lies right on the ocean, which strengthens both imports and exports. Jakarta is the capital of Indonesia and is the largest and most populous city in the country. Indonesia is known for its tropical climate, which brings travelers from around the world to vacation here. A large portion of Indonesian business comes from tourism. Indonesia is an archipelago made up of 18,000 islands. Aside from the tourism, Jakarta has an abundance of mineral wealth including everything from copper and gold to steel and oil. This drives the country's strong export economy. Financial transactions and lending have traditionally been difficult here due to problems with infrastructure. So investors have been pouring their money into startups which promise to solve these issues while delivering solid returns. Chicago. Illinois is the 3rd largest city in the U.S. According to statistics, Chicago is known as the Windy City of the Midwest and lies along the shores of Lake Michigan, which is one of the Great Lakes of North America. Chicago has always been a United States financial hub, second only to New York City. Everything from stock options to commodities goes through the financial portal at the Chicago Mercantile Exchange, CME, and the Chicago Board of Options Exchange, CBOE. Besides its financial role, Chicago is known for its commercial real estate empires and for the imports and exports that come from the Great Lakes. Recently, tech firms and startups have been coming to Chicago, inspiring bright hopes about the city's future. Cebu City is known as the Queen City of Southeast Asia. It's the 2nd most populous city in the country, just after Manila. The climate is tropical and is less prone to natural calamities. Moreover, the city is strategically located, as it is in the center of the Philippines. This makes it a trading hub for the country and for exports as well. Under the Philippines' new president, Rodrigo Duterte, who will hold office until 2022, there has been an economic shift in the country. New economic partners in China are pouring investments into many parts of the country. The Philippines has long done business with China and with its other neighbors in Southeast Asia. This has provided a steady flow of minerals, oil, and agricultural products. Cebu City continues to grow rapidly, and the inflow of business, tech, trade, and real estate construction projects make this city popular with investors. There are many cities around the world in which you could invest your money. However, there are only a handful that continue to thrive. We hope that you look hard at the cities listed here and make sound decisions involving any investment you make. The journey to paying down your debt can be challenging in the best of times. It can be even more complicated when you're balancing the effects of a global recession. Many Americans are facing immediate financial uncertainty from losing their jobs or being underemployed. The economic repercussions of this pandemic recession will be felt for years to come. Although becoming debt-free might not be your top priority during this difficult phase, you should still take steps to maximize your money. The first on this list of debt consolidation tips is asking your creditors to lower your interest rates. Many borrowers don't realize they can contact their existing credit card providers at any time to request a lower interest rate. This often overlooked tactic is a quick and easy way to reduce your debt burden. and it may result in a permanent or temporary, e.g., 12 months, interest rate reduction. Creditors are more likely to say yes if you have a history of on-time payments or if your credit score has recently increased. Even if that's not the case, the worst thing your creditor can do is say no. If you aren't successful in lowering your interest rate, don't hesitate to ask again after a few months or after receiving lower offers from competitors. Credit card providers can issue reductions at their discretion, but it's up to you to initiate the request. High-interest loans and credit cards can prevent you from climbing out of debt. Although you're hard at work making payments, interest charges are continuously accruing. This interest can quickly eat away at your monthly payment instead of chipping away at the principal balance. To help make some headway in repaying your debt, see if you can pause payments on your lower interest loans. Then, devote those funds to your higher interest debt. This lets you eliminate your balance faster and save you from unnecessary interest charges. Options for loan deferment vary by lender. In some cases, lenders might offer an interest-free deferment. Other lenders might continue charging interest on your loan during deferment. Contact your lender to determine if deferment is available and for how long. Even a pause of 2 to 3 months can help you put a noticeable dent in your high-interest debt. You can quickly reduce your overall interest by taking advantage of low or 0% APR balance transfer credit cards. By transferring your existing balance from a higher interest card, you can save money and pay down your balance quicker. A low interest rate or promotional offer, however, might come with an additional cost in the form of a balance transfer fee. For example, a creditor might offer 18 months of 0% APR when transferring a balance from another card. This perk typically comes with a 3-5% balance transfer fee that's calculated based on the transfer amount. In this scenario, you could tack on up to $300 to $500 in transfer fees if you transfer an existing $10,000 balance to a new card. You'll need to weigh your potential savings versus the transfer fee to determine if this is a good debt consolidation strategy. Additionally, your new card might have transfer limits or a short introductory period before a higher interest rate kicks in on any remaining balance. Be sure to read the fine print and stick to your repayment strategy, so it doesn't end up costing you more in the end. Whether it's your mortgage, student loans, auto, or other consumer debt, you might find a lower interest rate by refinancing your loan. Refinancing is one of the most helpful debt consolidation tips you should know. Refinancing replaces your existing loan with a new loan, usually with a lower interest rate or better terms. You might qualify for a better rate than when you originally took out the loan if your credit score has since improved or if consumer loan rates have dropped. Mortgage and student loan refinancing rates are at record lows since this pandemic began, which is a small silver lining in otherwise tragic health and economic crisis. The bottom line is if you can find a lower interest rate for any of your loans, take action. Remember, there might be associated refinancing fees or closing costs depending on the type of loan and lender. In some cases, you can benefit from modifying an existing loan instead of refinancing it into a new loan, particularly if you need immediate relief due to financial hardship. Depending on the type of loan, the refinancing process can take months, as is the case with some mortgage refinancing options. Loan modifications, however, can be processed in a short period. Loan modification can make your payment more manageable by reducing your interest rate or lowering your monthly payment. It can also extend your loan terms, which typically costs you more money in the long run. Contact your lender to explore loan modification opportunities. Always make sure you fully understand the terms and structure of your modified loan before moving forward. If you have high interest debt, you may be able to consolidate multiple balances into one low interest loan. This can save you on interest fees, but it can also streamline your payments into one due date, which can prevent missed or late payments. It's best to grab quotes from at least 3 lenders anytime you're consolidating or refinancing your debt. By comparing multiple offers, you're getting the best current rate since lenders are competing for your business. I recommend shopping around for all types of loans, especially for better student loan rates. Student loan debt, totaling more than $1.64 trillion in both federal and private student loans, surpasses all other forms of debt in the U.S., apart from housing debt. Because of this, there are plenty of opportunities to refinance or consolidate your student loans. If you already have private student loans, you should be shopping around for better interest rates at least once per year. Lowering your interest rate is the priority. But also compare origination fees, repayment terms, and any available cashback offers to pay down your debt further. If you have federal student loans, the decision gets more complicated. Depending on your financial situation and career goals, it might be more advantageous to keep your existing federal student loans due to their various protections, e.g., deferment and forbearance, flexible income-driven repayment plans, and available forgiveness programs. Before consolidating a large amount of debt, take steps to improve your credit score. The higher your credit score, the better interest rates you'll be offered. These actions can help lower your credit utilization rate while maintaining your credit history length. Both are important factors in determining your credit score. Another often overlooked debt consolidation tip is canceling small credit cards. If you use a debt management program or a debt consolidation loan, you might be required to close certain credit card accounts as part of the agreement. This gives the lender more confidence that you won't run up new balances and increases the likelihood that you'll repay the debt. Even if you choose a different method of consolidation, it's a good idea to cancel your smaller or newer credit cards by choice, or cut them up, to discourage you from using them. With endless opportunities to borrow money, payments can slip through the cracks. Check your credit report periodically to ensure you haven't forgotten about a small loan or debt. For example, you may find that a medical bill has been sent to collections without ever physically receiving a notice because it was sent to a previous or incorrect address. Perhaps you simply forgot about a loan that has an old email on file. You could be in default without realizing it. You're entitled to one free copy of your credit report from each of the major credit reporting companies, Equifax, Experian, and TransUnion, every 12 months. By keeping an eye on your credit report, you can head off any surprises and actively resolve any financial issues that arise. An often overlooked debt consolidation tip is signing up for a budget tracking service. It's easy to become detached from your money when you're swiping your credit card instead of paying with cash. This psychological separation leads to overspending and more debt. Free and paid budgeting tools can help you reconnect with your finances and keep you accountable along your journey. Platforms like Mint or You Need a Budget (YNAB) can help track your expenses and give you a big picture view of your finances. There are many free and paid budgeting tools out there. So find one that matches your financial needs and goals. Although these debt consolidation tips can help you save on interest and streamline your debt payoff strategy, it's only one piece of the financial puzzle. If you're spending more than you're earning, you'll continue to get trapped in the debt cycle. Start by setting a realistic budget, which might include significant lifestyle changes. You might need to trim down some of your expenses or find a way to bring in additional income. By relying less on credit to make ends meet, you'll reduce the likelihood of repeating the debt cycle. Text source: lifehack.org.